Guess what?
It's working. Yes.
The microphone is working without feedback. This screen monitor, whatever, you can place the bowl.
Okay, good afternoon, everyone. Let's get this lecture underway, please. Thank you to those of you who submitted your assignment. We've received them, and we're now in the process of marking all your assignments. So we're hoping to get them back to you in 10 working days. So hopefully we're trying our best because there's quite a few number of assignments that we have to mark. Just a quick reminder, your third multiple choice test is this coming Friday. So midday Friday, make sure that you don't forget. So today we'll be moving on to another area of corporate decision making. We'll be talking about the payout policy. For the last 8 weeks, we talked about the investment decision, the capital structure, or the financing decision. Today we talk about the final area of decision making, which is the payout policy. Essentially, what we're talking about today is once the company makes profits, how is it going to return all the cash to the shareholders who are the rightful owners of the company. So that is the topic of today's lecture. So there's a couple of things that we are going to go through today. We're going to have a look at an overview of payout policies, and then we'll look at the question of how a company actually decides on the payout policy. There are 2 questions that we have to answer here. How much do we pay out? And secondly, what form does that take? So we're going to look at that in more details. We'll look at the information content of the different forms of payouts. In general, there are 2 main forms of payouts. A dividend payout, which is probably quite common, so that's probably something that you're quite familiar with, a dividend payout. But there's also the other form of payout, which is share repurchases. So we'll talk about that and see how those 2 different forms of payouts can actually convey information about the prospect of the company. And then at the end of the lecture, we talk about the payout controversy. Pretty much I'm going to present to you a couple of discussions about how much dividend or how much payout altogether the company should make to the shareholders in general to improve the firm's value. So that's today's agenda. Now, you know the story. A company exists to pretty much add value to the shareholders. That's why a company exists. So in doing so, it's carrying out some sort of core business, and most of the time it will be profitable. There's all sort of expenses that it has to pay, all the salaries, all the rents, all the interest payments, so on and so on. At the end of the day, it will be left with some sort of profits. Now, other things being equal, that profits belong to the shareholders because we know that the shareholders are the owners of the firm and therefore they are entitled to that residual profits. But in reality, what happens is not all firms, as a matter of fact, a very small proportion of firms actually pay everything out as dividends. They don't. They only pay a small proportion of after-tax profit out to the shareholders in the form of dividend or any other form of payout. So what do they do with the rest of the money? And why is it that the shareholders are happy for the firm to retain the cash instead of paying out? Now, if you are the shareholders, would you be very happy if you know that the money belongs to you, but the company chooses to keep it within the firm? Now, of course, if the company is going to do something very silly with the money and is not going to generate any return on that cash flows, then you would be very concerned, wouldn't you? Because effectively speaking, that is your money. However, in most circumstances, shareholders do not have a problem with the companies retaining part of the profit because they know that that money is going to be reinvested in future investment projects. So that's why they're okay with it. Now, of course, there would be the situation of a cash flow problem because if you get a dividend, effectively you get a cash flow, you get some money coming in your bank account. So if the company doesn't pay dividend, then obviously you don't have that sort of cash flow. But what you could have done is you can actually sell your shares to get the cash flow. So the trade-off here is the firm either pay dividends or retain that earnings within the firm, but then it has to reinvest it in such a way that it adds value in the future, which at the end of the day will increase the share price. So the trade-off is either you get dividend now or leave the money within the firm and hopefully it will be reinvested to result in an increase in the share price. So that's why shareholders are happy for the firms to retain the cash within the firm. So pretty much is a consumption now or consumption later problem. If you get dividend, is current consumption. You've got the cash ready to go if you want to spend it now. If the company retains the money in the firm, it's going to be for future investment, and therefore you're going to get some sort of capital gain in the future when you sell your share. So if the companies decide to make payout, so obviously different companies would have different investment opportunities or projects, and therefore different firms would have different level of payout. Really depends on its situation. But in whatever cases, whenever a company decides to make a payout, it is out of after-tax profit, and it is the board of directors that makes this decision. Now, if you can recall last week, I gave you an example about Microsoft and how for a long period of time it didn't pay out anything as dividend, simply because Microsoft was going through a period of high growth. So it was founded in, I think, 1975, and it was going through a period of very, very high growth, and it needs a lot of capital for future investments. For that reason, it didn't pay any dividend to the shareholders, not a single cent, until 2003. So for 28 years, a very, very profitable company didn't pay anything out at all. But then that all changed in 2003, so obviously it got to a point where it had more cash than it needs to make future investments, so that's when they started paying out. And when they did, it was a huge sum. I think they paid out about $76 billion altogether in dividends and share repurchases combined. So in terms of the payout policy, so when we try to look at the payout policies, we assume that the investment decisions are fixed. So we try to set that aside. We assume that the investment decisions, all the investments are already made, all the financing decisions are already made. So the only thing that we vary in this situation is just the payout policy. So that's why we just try to focus on that particular bit of decision making. So the payout policies involve two essential questions, as I mentioned. The first question is, how much do we pay out to the shareholders, or how much does the firm pay out to the shareholders? Of course, this decision depends largely on the investment opportunities that the company has available. A growth company obviously tends to retain a lot more profit just because that it needs the money to invest for the future. On the other hand, if the company is more established, is more mature, and has less investment opportunities, they tend to retain less and pay out more. So it really depends on the type of the firms that we are talking about, on the stage of the life cycle of the company. The second decision that we have to answer is, once we determine how much we're going to pay out to shareholders, the second question is, what form does it take? How do we pay out? Generally speaking, there are two major forms of payout. The first is the dividend, which is probably a very familiar concept, a dividend payout. And the second form of payout is a repurchase, which is becoming more and more popular. Now, when we look at the payout policies, please keep in mind that just like all other type of decisions that are made at the corporate level, there might be an issue with the agency problem. The agency problem here refers to the fact that the owners of the firm and the shareholders are two different groups of people, and therefore the managers might not be acting in the best interests of the shareholders. Now, the most common type of agency problem in relation to the payout policy is managers or the board of directors do not make the payout when they actually should. Just imagine this: you are director in a company. You make the decision of how much money you want to pay out to the shareholders. You don't know these people, obviously, they are shareholders in the firm, but you don't know them personally. So it is actually in the manager's or the director's interest to keep the money in the firm, because that means that they have more money at their disposal. So this problem represents the agency problem in the payout policy, and this is common in all areas of corporate decision making. So just keep in mind that it can be a problem. What can we do about that? Shareholders can, try to monitor the firm, can and it's costly, obviously. Or if you are not happy about the firm because it pays out too little dividend, for example, then the easiest thing that you can do is obviously just to sell your shares and move on to another investment, like try to buy shares in another company. Okay, so as I mentioned, there are two main ways in which companies can return the cash to the shareholders. They can do a dividend payout, which is common. The dividend payout can take two forms. It can be in the form of cash, in which case the shareholders get a check or a deposit in the bank account, so it's a cash payout. Alternatively, the company can also make a stock dividend. So in a stock dividend, instead of receiving the cash, the shareholders have an opportunity to buy additional shares in the company. Okay, so they don't get the dividend, but they have more shares in the company. That's a stock dividend. But we talk about that in a little bit more detail a bit later on. And the second form of payout is a stock repurchase. Now, a stock repurchase is when the company uses the money to buy some of the existing shares in the market. The result of a stock repurchase is to reduce the number of shares outstanding in the market. So you're going to reduce the number of shares outstanding. There are different methods or different ways in which a company can repurchase the shares. They can buy the share on the market, so they can enter the market just like any other market participant and start buying the shares. So if they do that, then obviously the price at which they are going to repurchase all these shares are determined by the market. So it's the market price at which they are repurchasing the shares. And the market price is determined by demand and supply, obviously. The second type, or the second method in which a company can repurchase stock is to do a tender offer to the shareholders. So this is when they send a letter out to all the shareholders and say that we are going to buy back, say, 50 million shares at $20 a share, and it's up to the shareholders whether they want to sell or not. So the company is inviting the shareholders to sell their shares back to the company at a price which is fixed by the company. Now, this is different from an on-market repurchase, because with an on-market repurchase, the company didn't set the price. They just buy at the market price, whereas when in a tender offer, the company actually set the price at which they want to repurchase the shares. But other things being equal, usually a tender offer comes at a price which is higher than the market price to give the shareholders any incentive to sell. So usually they are set at a premium. Yes, it can. It can be an arbitrage. Well, I mean...
Or is that arbitrage?
No, but the problem is... No, it's not. It's a normal repurchase transaction. So, now, it can be an arbitrage, but the problem is this arbitrage opportunity is not available to everyone. Only a certain number of people can actually participate in the repurchase. In particular, only the existing shareholders. So yes, it does represent a handsome profit for all these shareholders, given the current market price. Exactly. I mean, I guess it depends on your assessment of the future prospect of the firm. If you think that in the next year the share price is going to go up even a lot more than what you can sell right now, you might think twice about it. But other things being equal, that provides a very attractive option to the shareholders, just to sell the shares at a premium. But usually that's what companies do, just to give shareholders an incentive to sell their shares back to the company. Or they can do a Dutch auction. With this auction, the company said, we are going to buy back 20 million shares. Tell us how much you want to sell your shares to us for. So in this particular case, the shareholders write in and say how much they want for their shares. So it's up to the shareholders to determine how much they want to sell it for. Now the problem is, if you ask for a price which is too high, then you are unlikely to, your share is unlikely to be repurchased. Because it really depends on how much other shareholders are demanding for their shares. So this is, if you want, a reverse auction process. So it's reverse auction. So the company will look at all the offers and they go from the bottom up to the top. So they start with the cheapest one, the cheapest offer, and they start going up until they can repurchase the desired amount. So this is an auction situation, but it's like a reverse auction because you go from the lowest to the highest. Or the company can be involved in a private negotiation situation. In this case, usually the company tries to negotiate with a major shareholder, so a big shareholder. This is usually an institutional investor, for example, so they get into direct negotiation with its shareholders and try to buy back all the shares that a particular institutional shareholder has in the firm. So two main types of payout, a dividend payout or repurchase, and under each of these methods of payout, you can do it quite differently. Dividend, you can have a cash or a stock dividend, and with a stock repurchase, there are 4 different ways in which a company can conduct a repurchase. But at the end of the day, the end result is the same. The end result is that the company is reducing the number of outstanding shares in the market. So from the point of view of shareholders, do they actually have a preference over one form other than the other? So if your shareholders do you have a preference, whether you want a dividend or whether you want a share repurchase? Now, in both situations, what you get is you get some sort of cash inflow. There's some technical difference though. The technical differences are when you get the cash dividend, you still have the shares, whereas when you get, whenever you resell your shares to the company, you no longer have the shares. But what you get is you get a capital gain, because usually you get a capital gain. If not, you are unlikely to sell the shares. So in a perfect capital market, then it probably doesn't make much difference whether you are getting a dividend or a capital gain, because either way that represents a return to you. And when you are an investor or when you are a shareholder, what you after at the end of the day is to get a positive return. So the larger the return, the better it is going to be. So it doesn't matter what form the return takes, whether it's a dividend or whether it's a repurchase, as long as you get a return, you are happy. Now, but when we take into account a number of other factors, then maybe a different group of people would have a preference over one form of payout compared to other. Now, one important consideration is the way in which dividends and capital gains are taxed. Because when you get dividends, you get taxed as the dividend rate, whereas whenever a company repurchases the stocks, if you make any money out of it in the form of capital gains, the tax treatment might be different. So taxation represents a very important consideration. Now, in the past, in the US, capital gains are actually, dividends are actually taxed more heavily than capital gains. So for that reason, many individuals who have a high marginal tax rate actually prefer repurchases, because they end up paying less tax on the amount of money that they get. But recently the US has had some sort of taxation reform that make the difference no longer significant. In Australia, you know that dividend and capital gains are both taxed at the personal tax rate, so both of them are the same. But dividends has a special treatment in the form of the invitation credits, which I'm going to talk about that a bit later. Whereas capital gain does receive some concession as well, and if you hold the shares for more than a year, so it's considered to be a long-term investment, then any capital gain that you make is entitled to a 50% concession. It means that if you make $100 of capital gains, you only pay tax on $50 because you get a concession, which is 50%. However, if you hold shares for less than a year, it's considered to be a short-term investment, you are not entitled to that 50% concession, therefore you pay tax on the full amount of capital gain. So taxation is important. Different individuals are in different taxation situations. Therefore, they may have a preference over one form of payout than others. At the end of the day, what do we want? We want more money. So that's why we want to minimize the tax payment that we have to pay. So whichever option that results in a lower tax payment, you would probably prefer that one. So that's logical. Now, from the point of view of the firm, they may also have a preference over one form of payout compared to others because of two things. The first thing is the information content of these forms of payout. In other words, what do these payouts convey to the market in terms of the future prospects of the company? Now, this is a very important consideration from the point of view of the firm because if it's considered to be a good news, then you usually see an increase in the share price. But if the market interprets the action to be bad news, you see a drop in the share price. So obviously, the companies would have a preference over the payout form that results in a share increase as opposed to a share decrease. So that is very important, but we talked about the information content of these forms of payout a bit later on. Another point of consideration from the point of view of the firm is the flexibility. And how easy can you do this form of payout? That's the other way of putting this. And in relation to this point, in recent years, you can see that in the US, share repurchases have becoming a very dominant form of payout. And one of the explanations is it provides the firm with a lot of flexibility. It can do a share repurchase whenever it wants. Whereas, in terms of dividend, this relates back to the point about the information content of dividend payout. Whenever there's a change in dividend, the market will try to get some information out of that, and therefore the share price will be impacted upon. In other words, if the companies have a lot of money sitting there, okay, it can choose. Well, it knows that the company knows that it's going to pay out to the shareholders. If it's do a share repurchase, that's it. Whereas if it increases dividends, then in the future, if it doesn't have the form of cash to support that increase in dividends and it has to drop dividends, then that is extremely bad news. So whenever there's a drop in dividends, it is bad news and you see a huge decline in the share price. So because of that flexibility attached to share repurchase in the US, share repurchase has becoming very, very popular. So having said that, let's have a look at the a graph that tells you what sort of payouts that have been made to the shareholders in the US over a 28-year period from the 1980 to 2008. Okay, so to understand this graph, the red column indicates the amount of dividends that have been paid out. The blue columns represent the amount of share repurchases in dollar amount. And then the yellow column represents the amount of retained earnings. Now, there's probably a number of important observations that you can take from this particular graph. I guess the first observation is you can see a rapid increase in share repurchases. So if you look at the blue column, you see how possibly starting from 1996, it's starting becoming very, very dominant. And as a matter of fact, if you look at the last 5 years, the amount of share repurchases are way over the amount of dividend payout. So in terms of dollar amount, share repurchases are representing a much larger proportion compared to dividends. So I guess that's the first interesting observation, that dividend is becoming less and less popular, whereas share repurchases is becoming more and more popular. The other observation, which I find quite interesting, is the fact that the company or the companies are committed to doing dividends and share repurchases, although it means that the retained earning would be negative. So it appears that the after-tax profit is not enough to make the dividend payout plus the share repurchases. obviously the company has to finance this dividend payment and these share repurchases by some other form of finance. So I guess that's the other point which is quite interesting as well. This is the...
You get a lot of companies that are making a loss and they'll contribute to that yellow column, whereas you get a lot of companies making a gain and they'll contribute to the green.
Yes, but the point is, overall, they're paying out more than they make. So that would be, if you're looking at this, there would be a number of firms who are paying out more than their profits. Okay, so if they pay out more than the profits that they make, obviously they have to finance the deficit one way or the other. So I don't know whether by issuing debt, issuing equity, I don't know. But it appears that those period of time appears to be during the period of the share market, downturn as well. So, this is probably the dot-com bubble, 2000 to 2002, and over here you've got the global financial crisis. So it appears that for the period of time that the companies pay out more than they make tends to be during the financial crisis. Now, one of the explanations might be the fact that the companies, they actually committed to all these payout policies, and they are reluctant to make changes to the payout policies just, temporarily. So, I mean, if they are just going through 1 or 2 years of difficulty, 1 or 2 years of low earnings, they would be very reluctant to cut dividends and to cut all the commitment in terms of share repurchases. Of course, I mean, if it's permanent, if the change in earnings is permanent, then they would have no choice but cutting dividend and cutting share repurchases permanently, because if you can't keep financing the shortfall forever. But if it's just for a year or two, then they are willing to do this just because of the information content of a change in the payout policy would convey to the market. Basically, whenever there's a cut in the payout policy, the market believes that it's a bad news for the firm because that conveys the information about a negative growth prospect of the company. So this is a very interesting graph because it tells you a couple of things about the pattern of payout, and also tells you how committed companies are to their payout policies, and they are reluctant to make temporary change to the payout policies. So recent studies have shown a number of interesting observations in relation to the pattern of payout in the US. The first interesting observation is dividend is getting less and less popular. Now, the proportion of firms that pay out dividend tends to decline sharply in the last 20 years. So in the past, I think probably about 70% of firms actually pay out dividends. Nowadays, probably about 20-25% of firms that actually pay out dividends. Now, so the proportion of firms that pay out dividend declines, the actual size of dividend declines as well. So in terms of how much they pay out in the form of dividend also decline. Firms that are only paying dividends seems to become extinct. So there's no more category of firms that only pay out dividends. And also, another observation that has been made in relation to the case of the US is the fact that there's no more special dividend. A special dividend is a dividend when it's a once-off dividend, and it's usually made when a company makes a huge profit in a particular year. But a special dividend is something that is not likely to be repeated. Now, but nowadays, special dividend seems to disappear altogether, because whenever the company makes a huge profit, and if it wants to return that to the shareholders, what it does is that it goes through a share repurchase process. So that's why the special dividends appears to disappear altogether. Stock repurchase as opposed to dividend is emerging as the most popular form of payout for US corporations. So nowadays, stock repurchase is very, very popular. And there are three main groups of firms that emerge. All of them tend to do share repurchase in one form or the other. So the first group is those firms that make regular dividend payment, but also make regular share repurchase as well. The second group of firms is those that make no dividend payment, but regular share repurchases. And the third category of firm is for those firms who do not pay dividends but make occasional share repurchases. So overall, the picture is that share repurchases has overtaken dividend as the most popular form of payout in the US. However, this pattern is only true in the US, and in other countries in the world it's not the case. So in other countries in the world, especially Australia, cash dividend remains the most popular form of payout. Now, I've just got this graph, our paper that came out in 2010 in the Pacific Basin Finance Journal. So basically what this graph does is it show you the proportion of total asset and also total sales that are being paid out as dividends by a number of large Australian companies. So I've got the black line here, which represents the proportion of sales that are made out to the shareholders in the form of dividend. And of course, the grey line here represents the percentage of assets that's being paid out as dividend. So in terms of sales, it's between probably, I don't know, about 6.8% to 9%. So on average, Australian companies pay out between 7 to 9% of sales in the form of dividends. If you look at assets, it's probably between 4 and 5%. So on average, companies pay out 4 to 5% of their assets in the form of dividend on an annual basis. Now, this one tells you a little bit more about share repurchases as well. So what they are is they tell you the percentage of firm that pay dividends. So that is the column here. I don't know how to describe this color. Is that yellowish or grayish? Beige? Okay. So this column here represents the percentage of firm that makes dividend payout. Okay. And then I've got this color I know how to describe. I think it's blue. So this blue column here represents the percentage of firm that makes share repurchases. Okay. So if I look at 96, for example, 43.9% of all firms paid a dividend, whereas only 1.5% of the firm made a share repurchase. And the rest of the firm, which is probably half, do not pay out anything at all. So they retain 100% of their earnings, possibly for future investment opportunities. So that's how you read this graph. So moving to a more recent year, in 2004, 34.9% of firm pay out dividend, 7% made some sort of share repurchases. So overall, there's also a slight decline in the number of firms that pay dividend, and there's a slight increase in the number of firms that make share repurchases, but overall, dividend remains the most popular form of payout. So I mean, there's purchases, but compared to dividends, they're quite a small amount. And also a smaller number of firms are actually engaged in this form of payout. So as I've said, regular dividends for Australian companies remain the most popular form of payout. So in Australia, if you are shareholders, you still expect to receive regular dividends payments. So the majority of companies only pay dividends. So dividend is the only form of payout for most of the companies. There's a small proportion of companies that do both. So they do dividend payout, but they also repurchase shares as well. The third category of firms that repurchase shares only, so they do not pay dividend, but they repurchase shares, is rare, so not too many of them. So if you think about it, is it possible that is a result of the imputation tax system? Because, well, in Australia we have a very special tax system in relation to the treatment of dividend payments, and it's called the imputation tax system. So essentially what the imputation tax system is doing is that it makes sure that investors, when they invest in shares, they only pay tax once at the personal level. Because in most other countries where there's no dividend imputation system, investors pay tax twice. How does it work? Whenever a company makes a profit, they pay a corporate tax. Okay, so that's the first layer of taxation, corporate tax. After the corporate tax has been paid, the money might be paid out to the shareholders in the form of dividends. When the shareholders get the dividend, they pay another level of tax, which is the personal tax. So for every dollar of earning that the company makes, there's two layers of taxations on it, a corporate tax layer and a personal tax layer. So this is commonly referred to as double taxation. And this tax system is commonly referred to as the classical tax system. So in a classical tax system, you have two layers of taxation on a dollar of earnings by the company. Now, in an imputation tax system, now the company still have to pay tax. So the company still pays corporate tax, but whatever corporate tax is paid is returned to the shareholders in the form of franking credits. So franking credits or imputation credits, so they mean the same thing. They are used interchangeably. So the imputation credits or the franking credits are a form of tax offsets. So once the individuals or the investors receive the dividends, they have to pay personal tax on the dividends. However, they can use the imputation credits to offset their tax liabilities. So essentially, because they can use that imputation credits, at the end of the day, they only pay tax once. They only pay tax at the personal level, because whatever tax that has been paid on behalf of the shareholders at the corporate level has been returned to the shareholders in the form of imputation credit. So the major objective of the imputation tax system is to remove one layer of taxation on dividend income. So with the imputation tax system, there's only one tax left, which is the personal tax. So I have some examples towards the end of the lectures that look at how you can actually calculate the imputation tax and how you can use the imputation credits to reduce your tax liabilities. Now back to the pattern of payout in Australia. Now because we have imputation tax system, if the company repurchase the shares, okay, using the same money, so let's think about a company. They have a certain amount of money sitting there that they want to pay out to the shareholders, right? If they repurchase the shares, the shareholders do not get the imputation credits because that is not treated as dividends. It is treated as a share repurchase. It's treated as a normal transaction that results in capital gains. So it's not treated as dividends, and therefore the shareholders are not getting the dividends. And if the shareholders are not getting the dividends, they are not getting the imputation credits. So in that sense, if the company choose to pay dividend instead, then they can also pass on the imputation credits to the shareholders. So that's probably why this is a predicted result from an imputation tax system. An imputation tax system gives a preference to dividend as a more popular form of payout, just because the shareholders can use the imputation credits. So that's why I've said a predicted result from the imputation tax system. In the circumstances where the company decides to make share repurchases, they usually do it off market, so they don't tend to go on the market and buy the shares on the market. They tend to do off-market transactions. So when they do off-market transactions, they usually set the price at which they want to repurchase the shares. So in Australia, for share repurchases of large amount, usually off-market transactions. And I think recently, Woolworth recently announced the intention to make a share repurchase very recently. I think it's probably last week, just a couple of days ago, that I read about it on the news. Okay. When a company makes a cash dividend, it can take a number of forms. It can take a regular cash dividend. It can be a regular cash dividend. Regular cash dividends tend to be paid twice a year. So usually they do it twice a year. You have an interim dividend and you have a final dividend. So the interim dividend usually follows the half-yearly half-yearly report, whereas the final dividend tends to follow the end of the year report. So twice a year, the investors get the dividends. The second type is special cash dividend. This used to be a lot more popular, but doesn't seem to be so popular anymore. A special cash dividend is a one-off dividend. So a special cash dividend usually happens when the company experiences a particularly good year. So if the company goes through a year which is highly profitable, and it may choose to pay more out to the shareholders, and if they do that, they usually do it through a special dividend. Now, it is important that they do it as a special dividend so that investors do not have an expectation that this thing is going to be repeated in the future. Now, you can understand that they are not going to do this as a regular cash dividends because this is one-off. This is just because the company is going through one particularly good year. If you do it as a regular cash dividends, the shareholders would expect this to be repeated in future years, which is not going to happen because obviously this is just a one-off thing. So that's a special dividend. Special dividend happen only once, unlikely to be repeated. But as I said, special dividends tends to kind of disappear because instead of making a special dividends, firms nowadays tend to do a share repurchase instead. And then many companies also have a dividend reinvestment plans. So when companies has this sort of plan, instead of making cash dividends payment, they offer the shareholders additional shares in the company. So effectively, shareholders use the cash dividends to buy some shares in the company. Now, if this is the way that the payout is made, then essentially there has been no cash leaving the company at all. So there's essentially no payout because everything is still kept within the firm. The thing that changes is there are more shares outstanding because you are granting all the shareholders additional shares in the place of the cash dividend. The dividend and reinvestment plan, again, depends on personal circumstances, but hasn't been quite very popular, possibly because shareholders still have to pay tax on the dividends because it's still treated as a dividend. So they still have to pay tax, but they don't get a cash flow. So it hasn't been quite popular. In some circumstances, the companies can still pass on the imputation credits to the shareholders via a dividend reinvestment plans as well. Okay, so how does a dividend payment process look like? It's a lengthy process, and usually it takes about 2 to 3 months. As I said, dividend is determined by the board of directors. So each year, after they have figures about the profitability, the board of directors usually meet and determine how much dividend that they want to pay out. Now, once they decide on the amount of dividend, they are going to make an announcement. So the announcement date or the declaration date is the date at which the companies announce the amount of dividend that they are going to pay out to the shareholders. Dividends are usually expressed as a dollar amount per share. So in these particular examples, they are paying out 42 cents per share. So for each share that you are holding, you are getting 42 cents in dividend. So that's when they declare the date. Now, at this date, at the declaration date, they also specify the ex-dividend date, the record date, and also the payment date. So all these dates are determined here at the very beginning of the process. So all these dates are determined here. Now, of all these dates, the date that is probably of most interest to shareholders and to investors alike is the ex-dividend date. So what is this date and why is it interesting? Because if you buy the shares before this date, you are entitled to the dividend payment. Okay, so if you buy before, in this case, if you buy before May 11th, you are allowed to participate in the dividend payment. Whereas, if you buy the shares after this date, you are not allowed or you are not entitled to this particular dividend payment. Now, of course, you are entitled to future dividend payments, just not this particular one. So, for this reason, the ex-dividend date here is of interest to investors because other things being equal, what do you expect to happen on this date? You would expect to see a drop in the share price, obviously. You would expect to see a drop in the share price. So that's why this one, out of all the dates on this slide, is the most interest to investors. Now, 2 days after the ex-dividend date is the record date. So essentially, the record date is just, the record date is determines who will get paid. So essentially, whoever are on the share registry on this particular date will get paid, and whoever who are not will not get paid. These 2 dates are related because if you buy shares on this date, it takes 2 days for your name to appear on the share registry because the processing time is 2 days. If you buy on this day, it takes you 2 days. Takes you 2 days for the name to appear here, and therefore you are entitled to the dividend payment. You buy after this date, doesn't give you enough time to appear on the share registry, and therefore you don't get the dividend payment. And of course, there comes a payday where you get a check in the mail or you get a deposit in the bank account, which is the payment date.
With the registration fee for anyone that owns the shares on May 10th?
No, is the rate. So anyone who are on the share registry on this particular day, May 13th, will get paid. But if you buy the shares after May 11th, it doesn't give you enough time to appear on the share registry because it takes 2 days for all the paperwork to go through and for your name to appear on the share registry. Okay? So if you want to be on the share registry on May 13th, you have to buy the shares by May 11th at the latest.
So if you bought the shares on May 11th and sold them May 12th, would you get dividend?
Of course not. Then obviously you are no longer a shareholder. Then how do you get the dividend? No one gets the dividend in this case. If you buy May 11th, sold it May 12th, you don't get the dividend because you're no longer the shareholder. The person who buys it from you do not get the dividend because he or she is not on the share registry. Okay? So that's the mechanics of the whole process. So what is the impact of cash dividend? Now, other things being equal, whenever the company makes dividend, this is for you to imagine. Effectively, what they do is they make a huge payout of cash. Okay, so they pay out a huge amount of cash to the shareholders. So that represents a cash outflow from the point of view of the firm. And if you think of the firm as a pot of gold, then obviously the dividend payment results in a reduction in firm value. Because other things being equal, there has been a cash outflow. So we all know that on the ex-dividend date, the stock price will fall. But more importantly, how much does that fall by? Now, this is a very interesting question because it depends on many different factors. Now, of course, it depends on the amount of the dividend, that's for sure. But the amount of the dividend in itself, most of the time, cannot explain the actual movement in the share price. Sometimes the share drops a bit more. Sometimes the share drops by a bit less. So it really depends. So it really depends on the information content of the dividend payout as well. So just not the dividend, but also the information content. So if for now, just for simplicity, we just forget about information content. So we just assume that this particular dividend payout does not convey any additional information than what the shareholders already know what would happen to the share price. Now, other things being equal, if you buy the shares after the ex-dividend date, you're no longer entitled to the dividend. So if you pay no tax, let's say there's no tax, then you expect the share price to drop by the dividend itself, right? Because this is an equation. I pay $10, I get $1 of dividend, so I get 11. Okay, go X dividend, I don't get the dollar anymore, so I would only be willing to pay $1 less for the share. So that's common sense, right? But when you take taxation into consideration as well, you don't get the entire dollar because you pay tax on it. Okay, and let's assume we don't talk about imputation now, we just say a classical tax system. Okay, you get $1, you pay tax on it. So effectively, what you take home is the dollar of dividend take away the tax. So you only get, let's say, if the tax is 30%, you get 70 cents in dividend. So conceptually speaking, or theoretically speaking, on the ex-dividend date, the stock price should fall by the dividend times by 1 minus the personal tax rate, to reflect the fact that you get the dividend, but you also pay tax on it. So that's the theoretical share price drop after the ex-dividend date. And I mean, if you don't pay tax, then of course it has to drop by the whole amount, but if you pay tax, it drops by a bit less. Okay, I guess it's almost 5 o'clock, so I give you a bit of a break, and then we get back to this lecture. Okay, everyone. Okay, I hope that you had an opportunity to stretch your legs, and let's get back to this lecture. Okay, apart from a cash dividend, the companies might choose to pay a stock dividend as well. So this is very similar to the dividend reinvestment plan. Instead of getting the cash, the shareholders get additional shares in the company. So I've got an example there. A 5% dividend means for every 100 shares that you are currently having, you are getting 5 more. A share split, increase the number of shares in multiples. So if you do 2 for 1, it doubles the number of shares. This one doesn't have that huge impact. But in the sense that increase the number of shares outstanding is quite similar. Yeah, but you can get imputation credit for this one. You can't get imputation credit for the other one. Okay, now I hope that you're all back to your seats. Okay, so for those of you who just come in, we're just talking about stock dividends. So stock dividends, as I said, just similar to a dividend reinvestment plan, you get more shares instead of getting a cash payment. Now, similar to a cash dividend payment, you also see a drop in the share price as a result of the dividend, holding other things being equal. Now, in this particular case, the drop in the share price is not because that the firm value has declined, because essentially there has been no cash being paid out to the shareholders, but in this case, the share price goes down because there are more shares outstanding. So the share price drop here is due to a dilution effect. You have more shares than you used to, so that's why there's a drop in the share price. Stock dividends, although you don't get any cash, income tax also applies on stock dividends. So you still pay tax, but you also get imputation credits. But again, how much imputation credits that you get, or whether the dividends are fully franked or not, depends on the company. But these days, most companies pay out fully franked dividends, meaning that you get 100% of the imputation credit. For every dollar of tax that the company has paid at the corporate level, the shareholders get the entire amount. If it's partly franked, then you get only a proportion of the tax that has been paid at the corporate level. So in setting the amount of dividend, what are a number of considerations that the board of the directors take into account? Because this decision at the end of the day is made by the board of directors. But according to a survey, a dividend decision survey, we can see that there's a number of important factors here. So I'm going to go from the bottom up the top, because as the bottom one here is probably the more important consideration than the top one. So according to the survey, most of the executives agree with the statement that we try to avoid reducing the dividend. So this is consistent with the information content of dividends, because whenever there's a reduction in dividend, the market thinks that it's signaling a very poor perspective for the firm. So that is why companies are very, very reluctant to make a cut in dividend unless they absolutely have to. Okay, so of course, I mean, if there's a decline in the whole profitability prospect of the company, then they can't avoid this forever, because if they don't reduce the dividend, then it means that they have to finance the dividend payment one way or the other, and it's not sustainable. But other things being equal, executives are very reluctant to reduce dividend. So whatever it was last year, they want to make sure that at least they pay the same amount. So they don't want to reduce the dividend. They try to maintain a smooth dividend stream. So not, they want to, if there's an overall trend of increase in dividend, they want it to increase by, by a little bit, not by a huge amount. So it goes, very smooth over time, not up and down, up and down, up and down. Obviously, they look at the current dividend level in determining the future dividend, because they don't want to reduce it, so they want to make sure that whatever the current dividend is, that's the minimum that they're going to pay out. They're reluctant to make change that may have to be reversed. We consider the change in the dividend. So they take into account the change in the dividend. Rather than reducing dividends, we would raise new funds to undertake a profitable project. Okay, so again, this point here points to the fact that they're very reluctant to reduce dividend, even that means that they have to use up all the return earnings, and therefore they have to raise external finance to fund new projects. So that tells you how reluctant they are to cut dividends. The cost of external capital is lower than the cost of a dividend cut. So again, one more time, they illustrate the fact that a dividend cut is extremely costly, and the company is doing everything that it can to stop this from happening. So even that means that they have to go to the market to raise additional or external financing. Now, raising external financing is not cheap. You know that when you go out to the market to raise funding, you incur a lot of cost. Now, the obvious cost is the direct cost, all the issuing costs. If you issue shares, you've got the prospectus that you have to prepare, you've got the underwriting cost, all those sort of, legal fees, accounting cost, all those sort of thing. You can also incur indirect costs, especially in the situation of a share issues. The indirect cost might be in the form of a reduction in the share price because of the information that it conveys. But having said all that, the managers, or all these managers, consider that even those costs are not as much as the cost of cutting the dividend. So obviously you can see that a cut in dividend has a severe impact on the share price of the firm. Okay, so they very reluctant to make dividend change that may have to be reversed. So obviously they don't want to increase dividend if it means that in the future they might have to cut it, so they're not going to do that. Overall, they want to have a smooth dividend, program. So they just, try to smooth out the dividends. If there are any changes, that it should reflect the long-term prospects of the company, not temporary changes. So whether it's going to be an extremely profitable year or an extremely bad year is not usually reflected in the dividend. They still try to commit it to paying the normal level of dividends. And obviously, they're more worried about the change in dividend than the absolute amount. So it doesn't matter whether it's $1 or $2, as long as that's the amount of dividend that they can maintain from year to year. So those are the few things that we can take out from the survey. So the reason that we see all these observations is just because of the information that dividend can convey to the market. Now again, all this information content relates back to the concept of information asymmetry. Managers know more about the firm, so they know more about the future prospect, they know more about the true value of the shares. So that's the reason why shareholders tend to look at all the actions of managers to predict or to forecast the future profitability of the firm. So dividend is one way for them to do that. If there's an increase in dividend, obviously it's a great news, because managers would only increase dividend if they believe that there's a long-term improvement in the firm's profitability. So they would only do that if that's the case. So when there's an increase in dividend, extremely good news, you always see a share price increase following the announcement. And of course, at the other end of the spectrum, a dividend cut, very, very bad news. And as I have illustrated, managers are doing everything that they can to stop this from happening. So that's why, because of the information content in dividend, it explains why in reality you observe something that we call a sticky dividend policy. A sticky dividend policy means that every year the dividends appears to remain the same from year to year, no matter how profitable or how unprofitable the firm has been during a particular year, because the information content. So if you are shareholders, you probably notice that over time, you tend to get about the same amount of dividend from the companies that you have shares in. They just have a sticky dividend policy. Now, how about the information content of share repurchase? Now, we've talked about dividend. We know that there's content in there, and more importantly, there's information content in the change in dividend, not so much in the absolute value. So when there's a change, increase good news, decrease bad news. So that's why managers tend to have a sticky dividend policy. How about share repurchases? Do they have some sort of information content in it as well? And the answer is yes, it does. Now, before we get to that, let me highlight one major importance in the accounting treatment of share repurchases between the US and Australia. In the US, when the company repurchases the shares, they are recorded they're still recorded in the balance sheet as treasury stocks, so they are not cancelled. They've been brought back, they've been put under treasury stocks, and in the future, if the company wants, they can reissue the shares. Okay, so they buy back. If they want in the future, they can reissue this one. In Australia, it's a slightly different story. Once you repurchase the shares, the company, we go to cancel them, so they come out existence. So you cannot reissue them anymore. So once you repurchase them, you cannot reissue them. So this is one major difference. So this reason is probably one of the reasons why share repurchase is not very popular in Australia as it is in the US. So why do a company want to do a share repurchase? Well, I mean, obviously, first of all, if we try to put a positive spin on things, they want to return the cash to the shareholders, right? So that's probably one of the first reasons. But they can only do this if they have the cash sitting there. So usually a company would like to do a share repurchase when they have excess cash. If they don't, then we don't expect why they would do this, because we would expect them to use the money to reinvest. Another reason, a popular one, of why a company might want to do a share repurchase is to change their capital structure. And this is particularly common for firms that are undergoing some sort of restructuring. Okay, so we talk about corporate restructuring later on, but quite common for firms to do this whenever they want to increase the debt-equity ratio. Because effectively, when a company repurchases the shares, they reduce the number of shares outstanding. So other things being equal, the debt-over-equity ratio has gone up. So the capital structure of the company changes following share repurchases. So what are the information in repurchases? Now, as I said, when the company when the company pays out in the form of share repurchases, what they do is they're returning the cash to the shareholder. Now, we have to think of this as a very positive news, because if there is an agency problem in here, companies' managers might be reluctant to return the cash to the shareholders. They rather want to keep it within the firm so that they have more money under their disposal. Okay? So when a company is willing to distribute the extra cash back to the shareholders, that is good news, because they're showing that they make a commitment to return the cash that belongs to shareholders to the shareholders. Now, the other point is when there is a share repurchase, as I said, the debt over equity ratio declines. In some cases, especially when the company wants to restructure their balance sheet, they actually borrow to repurchase the share. So the result of this transaction or this action is to increase the debt ratio significantly. Why is it good news? Now, if you think about it, if you are running a company that is extremely profitable, you don't have an incentive to work very hard. It's just because it's so profitable. You don't have to try so hard, do you? And especially if you don't have any debt service obligations, your life is even easier. You don't have to worry too much. You make a lot of money, then you pay out a lot. If you don't make a lot of money, sorry, bad luck, we just don't make any money this year, therefore we don't have anything to pay you. But when the company has a lot of debt in the capital structure, it's a different story. Because what it means is every year the managers have to make obligated payments in the form of interest payments. So they have to make those payments. If they don't, the company is in serious trouble, and obviously their jobs are under threat. So that's the reason why when they increase the debt ratio equity, managers have to be more disciplined. They have an incentive to work a lot harder, just because they have a fixed obligation in the form of interest payment. So if you think of it that way, a share repurchase increases the debt equity ratio, making the managers more disciplined, so that is also good news. So less agency cost in the form of the commitment to pay back the cash, managers more disciplined. So overall, a share repurchase is perceived to be good news. So that's the reason why whenever a company purchases shares, you see the decision is followed by an increase in the share price. Okay, finally, let's talk about a little bit about the imputation tax system. I think I kind of briefly touched on this already. So now it's more about looking a little bit at the numbers to see how it really works. Introduced in Australia in 1987 as part of the overall financial market reform, aims to reduce double taxation on dividend income in the classical taxation system. So anything that the company has paid will be returned in the form of franking credits or imputation credits. They mean the same thing. Okay, now, so when the investors get the dividend, they do not just pay tax on the amount of dividend, they actually have to pay tax on the grossed up amount. What is the grossed up amount? The grossed up amount is the amount of dividend plus the amount of imputation credits. Okay? So you get the dividends, you get a statement in the mail saying that this is how much dividend that you get, this is how much imputation credits that go with the dividends. So the grossed up amount is the sum of those two, the dividend that you get plus the imputation credits or the franking credits. Once you gross that up, you work out your tax liability by applying the personal tax rate on that amount. And once you work out the tax liability, you can use the franking credit to offset that tax liability. You have a question?
Prior to 99, you had an imputation credit, and you didn't pay enough tax, you didn't pay it back, so you were effectively getting taxed when you should be taxed $4.99. Costello changed the law.
But it was introduced in 1987, though, the imputation, the broader system. I mean, it has undergone changes, obviously, but it was originally introduced in 1987. Originally, but over time, there's changes to the system. The same way that our personal tax rate keep changing as, governments come and go. But it was originally introduced in 1987. Okay, so this is how it works. Okay, so let's say the company has an income of $100. and it has to pay corporate tax rate at 30%. So in Australia, the corporate tax rate at the moment is a flat rate of 30%. So for every dollar that you make, you pay 30 cents in tax. Okay, so you've got the after-tax income, $70, 70, 70. Now, we're assuming this situation that the $70 here is being paid out as dividends, and all these dividends come with, they are fully franked, so they come with 100% franking credits. So what's the franking credits here? The franking credits is the amount of corporate tax that has been paid, which is $30. So this is the franking credits. Now, the gross up amount is, as I said, the amount of dividend, which is this one here, plus the imputation credit. So the gross up amount is $100. Different individuals have different marginal tax rates depending on how much money that you earn. So depending on your income. The more income that you have, the higher the marginal tax rate that you have. So let's say you are a very high income earner and you pay 47% in tax, then for the $100 you are liable to pay $47 in tax. Okay? So that means that you have to pay 47, but you get $30 back in the form of imputation credits. So effectively, you pay only $17 in tax, just because you had $30 to offset your obligation, your tax obligation. So the net cash flow is you get $70 in the form of dividends, you pay $17 additionally, and therefore you take home $53. Now, if you look at the number, you've got $100 of operating income from the company. You end up taking home $53. The difference between these two numbers represents the personal tax rate. So can you see that because of imputation, tax is applied only once at the personal level? In this case, this guy's paying 47 cents in a dollar. So for $100 income, he takes home 53. Now, if I move over here and look at a lower income earner who pays only a marginal tax rate of 15%, then what happens is, still have $100 gross up dividend, income tax is low $15 because it's 15% times by 100. You get $30 of franking credit, so instead of making an additional tax payment, you get back, so you get a refund from the ATO of $15. So effectively, you get $70 in dividend, get $15 from the ATO, so you end up with $85. Again, the difference between these two numbers reflects your marginal tax rate. The point at the end of the day is you only pay tax once at the personal level. I've got an example here, just so you can gain a better understanding of how you calculate the imputation credits and how you work out your tax liabilities, which can be quite useful because, last year for some reason I lost all the statements, so I have to manually work all this out for myself. Okay, so you've got $350 fully franked dividends from Qantas. The marginal tax rate, your marginal tax rate is 38%. Now, Qantas is a corporation, so it pays 30% tax rate. What is the amount of franking credits you received, and how much tax do you have to pay on these dividends? Okay. Oh, let's see if I can work the dot cam. I mean, we know that they're paying 30%. We know that all corporations pay 30%. Yeah. Okay, so how do you work out the imputation credit? Okay, so the imputation credit or the franking credits can be worked out using the following formula. The dividend that you received times by the corporate tax rate over 1 minus the corporate tax rate. Okay, so in this particular case, we have $350 of dividends. We know that Qantas paid 30% tax rate. So that works out to be $150. So what this imputation credit amount represents is that it represents the amount of tax that Qantas has paid in order to have $350 to pay out to you. So to get $350 of dividend, Qantas has paid $150 of corporate tax on this amount. I'm sure it's what? Are you asking me whether this is calculations correct? The 150 is correct? So yeah, 350 times by 0.3 over 0.7. Okay? Okay, so now, and remember, to work out your tax liabilities, you have to work out the gross up dividend. Okay, so the gross up dividend is 350 plus 150. Now you know that 150 is correct because it's 30% of 500. So you have to pay tax on this amount. Now your marginal tax rate is 38%. So you pay 38% on the 500. So your overall tax obligation on this dividend income is $190. But Qantas has paid $150 on your behalf. So now you only pay the difference, which is $40. So this is the credit, the franking credit. So this example illustrates how the franking credits can actually reduce your tax liability, reduce the amount of tax payable that you have to pay. So other things being equal, if your marginal tax rate is greater than the corporate tax rate, which is 30%, so if your marginal tax rate is more than 30%, you know that you have to pay additional tax on the dividend. But if your marginal tax rate is less than 30%, you know that you're going to get a tax refund. So you not only you don't have to pay any additional tax on that, you are going to get a tax refund because your overall tax liabilities is less than what has been paid on your behalf by the company. Okay, so just very quickly to look at the other part, assume now that your marginal tax rate is only 15%, what is your tax payable? Now, we already know that the gross up dividend is 500, right? So, you get a tax refund, yep. So that $75. Your overall tax liability is only $75. The company has paid $150 on your behalf, so you get back $75. So tax refund. So again, this 150 here is the franking credits. Okay, so I hope this little example illustrates to you the concept of the imputation tax credit and how it works and the imputation tax system. Okay. Now, in the last part of today's lecture, we are going to spend a bit of time to talk about the payout controversy. Basically, there are different groups of people with different opinions about how much dividend the company should be paying out. Now, we know that as shareholders, we have no control over this decision. This decision is made by the company, made by the board of directors. What you can do, of course, if you're not happy with the dividend policy, you know, the same way as when you're not happy with the financing or the investment policies, you can sell the shares and move on. So you go and buy shares in another company. So you can have an influence indirectly in that sense, but you don't have a direct influence in the sense of how much payout that you can get, because all those decisions are made at the corporate level. So how much should a firm pay out? So this is not going to be conclusive, because as I said, it's a controversy. So different people tend to have different opinions about what is best depending on their personal circumstances. So I'm going to present to you three different school of thoughts here. Again, we're going to visit the two guys, Miller and Modigliani, who said that it doesn't really matter how much you pay out. And then we talk about the rightists who argue that more dividends is better than less dividend. And then we talk about those who argue for lower dividends. Now, obviously, these Miller and Modigliani, they're famous for the assumption of a perfect capital market. We looked at that last week when we looked at capital structure. Now, the argument is, remember at the very beginning, we said that in order to understand the payout policy, we assume that all the investment and all the financing decisions have been made and they are held constant, right? So if you want to increase dividends, other things being equal, if you want to increase dividend, you have to finance that dividend increase one way or the other. Now, let's assume in this case that you're going to finance the increase in dividend by issuing additional shares. So this is what's going to happen. Now, this is before the company increased the dividend, and let's assume that the company has only 4 shares, okay? The total value of the firm is this much. Now, what it wants to do is it wants to increase the dividends, make a payout, but then it has to finance that payout by issuing additional shares. So essentially, in terms of the firm value, nothing has changed, because there's a cash inflow, but then there's also a cash outflow. The cash inflow is from issuing additional shares. The cash outflow is from paying the dividend. So the value of the firm is not going to change, assuming that there's no transaction cost here. So the value of the firm doesn't change. What changes is that now you have more shareholders because you issue additional shares to finance the increase in dividend. So you still have 4 old shareholders and you assume you have 2 new ones. Now, if you are the old shareholders, this is what's going to happen to you. Now you hold a share in a company which is worth less than what it was before, just because there are now more shares outstanding. But what you've got is you've got the dividend payment. Okay? So you still have a share worth a bit less, but the difference in the value is offset by the dividend payment that you received. So if you are an existing shareholder, it doesn't really matter to you, because although your share has declined in value, you get a dividend payment that offset the decline in value. So at the end of the day, it doesn't really matter to you whether you get a dividend payment and a lower share price, or you just get the original share without any dividend payment. So that is what M&M is arguing. They say that if the capital market is perfect, doesn't really matter. What is the implication of that? If the implication of that theorem is that if the payout policy doesn't really matter, whether it's just a lot or a little, doesn't matter, then the firm should be focusing on making good investment decisions, because that's where the most wealth creation is coming from. Obviously, because when you make good investment decisions with good NPV, that NPV represents the increase in wealth to you. So the payout policy should be adapted to reflect the investment policies. So it's a residual policy. It's residual in the sense that you should use the money to finance whatever positive NPV projects that you've got, and if you happen to have things that are left over, then you pay that out. Okay? Now, there's some truth in it, but obviously because of the information content of dividend changes, managers do not apply this blindly. If they do change the dividends because of changes in investment policies, they do it very slowly over time. They do not apply this to the letter and then making big changes in dividends. Also because of this, you see that the dividend payout will vary as the company goes through its life cycle. When it's young and it's growing so quickly that it has a lot of investment opportunities, that's when it doesn't tend to pay out dividends. Or if it does, it's very, very little. But as it becomes more mature, more established, then it should start paying out more and more dividends, because it no longer has the same number of investment projects to put money in. So the implication of this is that the dividend payout will change as the company goes through different stages of its life. But then, of course, there's always other opinions, and there's a group of people who argue that higher dividends actually increase value. How does this work? They base this argument on an effect which is called a clientele effect. A clientele effect said that if there is a group of people that have a demand for high dividends, then those group of people will start buying those shares, that high dividends, pushing up the share price. That's the argument. Why is it that some people actually have a preference for high dividends? Number of reasons. First, there might be a group of investors who have a demand for regular incomes. One good example is retirees. So a lot of retirees actually invest in the share markets so that they have a regular stream of incomes in the form of dividend. And if that's the case, to them, capital gain and dividend payments are not perfect substitutes. They are not, because they need the cash flows to sustain their lifestyle. So they do have demand for the regular incomes. Some other people might be risk averse. I mean, the risk averse here is in the sense that if you get the dividend, it's a bird in the hand sort of argument. You get it right now, you get the money right now. So the risk is less compared to leaving the money in the firm, let the firm reinvest on your behalf, and hopefully there's an increase in the share price at the end of the day. So again, depends on how you approach the whole thing here, whether you rather just get the money out right now, or you're happy to leave the money in there and wait to see an increase in the share price. So some people are risk averse and they just want to see the money right now in the forms of dividend. So because of these people who prefer high dividends, they might have demand for stocks that are paying high dividend, pushing up the price of those shares. The other reason is dividends might send a signal. Now we know that there's information content in dividends payout. So if the company can actually sustain a high level of dividend, then it means that it has to be profitable. It has to be profitable to be able to sustain a high level of dividend. If it's not profitable, if it goes through a couple of years of losses, then where does the money come from to pay for the high dividends? So a high dividend might be a signal of the manager's confidence in the future profitability of the firm. And if that's the case, high dividends should come hand in hand with higher firm value as well. And finally, we have another group of people who argue the exact opposite. Now, what I hope you can take on board is try to understand the motives or the underlying reasons behind all these arguments. Now, there's an element of truth in all of them, but as you see, it really depends on which group of investors you are talking about, and they're all different in their personal circumstances. The people who argue for lower dividends are mainly relying on a tax argument. They're arguing that if dividend attract more tax, there's no reason that the company should be paying high dividends, because you end up paying a lot more tax that way. Instead, the company should pay low dividend, leave the money in there, reinvest the money in good investment projects, and deliver an increase in the share price at the end of the day. The increase in the share price is capital gain, and if capital gain is taxed more favorably, then obviously that would be the preference. The other thing which is good about capital gain is that you can actually delay paying it. You only pay tax on capital gains when you realize your gains. As long as you do not realize your gains, you do not pay tax. So for those people, they actually prefer lower dividend. These people tend to be people with high marginal tax rates, so that's why they pay high tax on dividend. Also, previously, there's differences in the way that capital gains and dividends are treated, but nowadays, with all the tax reforms, the bias seems to reduce significantly. So they seem to be taxed at about the same rate now. How about in Australia? In Australia, obviously, as we highlighted, the imputation tax system is one good reason why dividend remains very popular, because it's the channel through which the company can give the shareholders the imputation credits. So that's the reason why. In terms of the taxation, they are both of them, capital gain and dividends are taxed at the same rate, which is the personal tax rate. But if you take into account the concession in capital gain tax, if you hold the shares for more than 1 year, then overall the broad picture is capital gain is still treated a little bit more favorably in a taxation sense, because you can delay it, you get a concession. So you might end up paying a bit less tax on those capital gains. So as I said, just make sure that you understand the argument behind all these different propositions and try to appreciate them. So that comes to the end of today's lecture. Thank you for attention, and I see you next week. in reality, you only get the dividend amount. So the dividend amount is the 70%. So if that's to be able to work out, the imputation credit will be different from here. So that's why you apply this method to work this out in this
That's the more realistic example.
This one is the more realistic example.
This one more realistic.
Because you get the dividend and you don't, you have to work out how tax you pay and so on. Yeah. You want to work with me?